Hello everyone, I welcome you all to the final section of the Forex Beginners course. And I hope you all have enjoyed watching and practicing just as much as I enjoy preparing this course. So welcome to the final section. So in this section, I'm going to be talking about how the fundamental and technical analysis relates, common mistakes made by forex traders, and how to manage risk properly. So let's get into it. So you should note that as forex traders, we use technical analysis to determine where price will most likely go. And it has been said that fundamentals, that is news, only creates volatility but not direction. As the popular saying goes, price action is king. And as I've said in the previous sections, that fundamental analysis, it is mostly news. And when there are some major news, there's always a very high momentum in the market. It brings a lot of volatility, and there's always heavy momentum. So what some traders say is that if you do your technical analysis very well, then you don't need to worry about fundamental analysis. Although you should make sure that you don't trade too close to news because it can weak you out and then continue your direction. But basically, what we are trying to say here is that technical analysis will always be technical analysis, and fundamental analysis will only support your technical analysis if you do it right. So the volatility that the fundamental analysis will bring, it will only support your technical analysis. So, and as a forex trader, you must know technical analysis very, very well because it is mostly what you'll be using. It is not every day that there will be a major news. So technical analysis is what is very, very important. And fundamental analysis only creates volatility and help you in your technical analysis. So let's go to the next thing, which is expectations and mindsets. So I want you all to correct your expectation and mindset also because in the forex industries, a lot of people have seen it as a get rich quick scheme. Of course, it's in the forex industry you can get rich, you can become a multimillionaire, you can have the time freedom you want, location freedom you want, travel the world. But you need to know that you have to put in the work. You have to do a lot of work. You have to put in the hours, go on the charts, back test, have a trading plan, and the likes. So it is not just all rosy. You need to know that there are going to be times where you are going to be confused. But what you should do is that you should just keep going and keep practicing and then um, practicing your craft and then making sure you get better and better. So that is the mindset I want you to have. I don't want you to have the mindset of forex is a get rich quick scheme. No, you can get rich with forex, but you have to put in the work and then um, perfect your craft. So importance of risk management. What is risk management? Risk management is basically capital preservation. Risk management is what keeps you in the game for long. So when we are talking about risk management, it is simply in forex market, capital is what is most important. You can't trade the forex market without capital, without an account. So if you don't have an account, you can't trade. So you need to manage that account and make it your priority. So that is why risk management is very, very important. And it is one of the least talked about in the forex industry. That is why I make sure that I talk about it in this course for you all to know. So because risk management is what will make you preserve your capital and not blow your accounts anyhow. So what you should do is that for each position you are entering, you should make sure that you are not risking more than 1% of your accounts. Because for you to blow an account risking 1%, it means you have to lose 100 times, which is almost impossible if you know what you are doing. If you know what you are doing, there's no way you are going to lose 100 times without winning a trade at all. So that is why you must not risk more than 1% on a particular trade. So with this, it will be very, very hard for you to lose your capital. So how do you manage risk? Use appropriate stop loss. When I was showing you examples of when I was teaching you how to do technical analysis the other time, you can see how I was placing my stop loss. I was not putting it in the middle of price action. I was putting it above a particular structure and making sure that my stop loss is protected. So a way you can manage risk is to make sure that you are placing your stop loss properly and not just anywhere in the price. So what you should also make sure is that don't make your stop loss too tight. So you have to give price a breathing space and make sure that it is above or below structure. So that is one way to manage risk. Also, never risk more than you can lose. Like I've said before, you shouldn't be risking more than 1% on a particular trade. Any position you are taking, make sure that you are not risking more than 1%. So that way, it will be very, very hard for you to lose your account. So stick to your trading plan. So as you progress, you are going to be developing your own trading plan. So and trading plan includes the type of setups you are going to take, your risk appetite, the zone that you prefer trading, the session that you prefer trading, what and this will heavily depend on the region that you are. If you are in the Asian region, I'm sure it will be daytime there during the Asian session, so you might want to be trading the Asian session. If you are in London region, if you are in New York region, you are going to be trading according to the region that you are. So trading plan also, it involves a lot of things, how you are going to make the trading journey easy for you. So you have to make sure that you stick to your trading plan. You don't risk more than necessary, and your stop loss is placed in the right place, and you are also not greedy. So stick to it, and it will keep you in the game for long. So don't overtrade because less is more. In the forex market, you need to realize that taking too many trades doesn't guarantee you having more money. In fact, if you trade less and you know what you are doing, it's you are most likely going to make more money than someone who is taking a lot of trade. Because in this forex industry, it is a game of probability and possibilities. Probability is what would most likely happen, and possibility is what are the other thing that might also happen. For example, if you are trying to buy a pair and you've already made your analysis, you need to also forecast that, oh, there is also a possibility that this pair might go in the opposite direction. So this type of things is what keeps you in the game for long, keeping an open mindset. So to the next one, don't over leverage. So there's something called leverage that your broker will give you. It's like an additional money that you're allowed to trade. The higher your leverage, the higher you are allowed to trade, the higher stop size that you can use. So don't over leverage, because as I've said before, if you are risking 1% per trade, there is no you will have no issue with this one. So the next one is don't be greedy. Lock in profit as price progresses. Whenever you are in a trade, you don't need to be greedy and be afraid that a pullback might take you out. No, you need to lock in profit as price is moving. So once your trade impulses away from your entry, then your stop loss, you shift it to your entry point. So when you shift it to your entry point, it means you are protected. Even if price reverses, it will only take you out without any profit. And once it creates a structure and then impulses away again, then you keep shifting your your stop loss to the point. So if price reverses, it is going to take you out in profit. That's how to trade. You don't just set your stop loss and take profits and then leave it for price to come and take you out. No, once price is progressing, you're also going to be shifting your stop loss to make sure that even if price reverses, this is going to take you out in profit. So these are some of the ways that you can manage risk. There are a lot of them, but these are the ones I can share with you in this section. So common mistakes made by forex traders: no trading plan. Like I've said before, trading plan will make it easy for you. It will make your trading journey easy. So it will eliminate a lot of low quality setups, because in your trading plan you are going to include um, the setup you are going to be taking, which I am sure is going to be high quality setup. And in this trading plan also, it is going to include invalidation criteria, where if price does a particular thing, then you know that okay, I'm going to stay out of this trade. I don't need to jump in. I have to wait for another trade that fits my plan. So traders that have no trading plan, it is one of their biggest mistakes, and they are not going to stay in this game for long. So the second one is paper trading for too long. Paper trading is simply demo trading. So if you are trading the forex market, you don't need to trade with a demo account for too long. You need to put your emotion on the line. You need to uh, get your skin into the game, get into the ring, and open a proper account or buy a prop firm account and start trading. Put your emotion on the line, because it is take trading a demo account is very very different from trading in the live market. Trading in the live market, it involves real money and your emotion is actually on the line. So if you are trading for too long might give you a false narrative that oh, you are now good in the market. No, you are not good until you can consistently make profits in a live market. So don't paper trade for too long. So the next one is ignoring the psychological aspect of trading. You see, many people would say trading is 10% technical analysis and then 90% psychological analysis. This is very true, because there are a lot of traders out there that know about technical analysis very, very well. But somehow there are not many traders that are profitable. Why is this? This is one of the it's also point to the fact that trading has more to do with psychology than just analysis. So you need to work on your psychology. You need to have a positive mindset. You need to watch what you say to yourself, how you see yourself, your self-image. You need to make sure that everything is positive. In fact, from what you listen to, what you watch, what you do before you sleep, what you do after you sleep, all these things they trickle and flow into your trading journey, and you might not know if you are not told. So that is why you need to make sure that your psychology is in a very very good place. You have a positive mindset all the time, and um, this is going to help your trading. So the next one is lack of proper risk management. I already explained risk management before, and it is just simply capital preservation. So if you lack the proper risk management, so you are not going to stay in the game for long, obviously. So you need to make sure that your risk management game is on point. It is top notch. That is how you are going to stay in the game for long. So greed and FOMO. So this is also some of the biggest mistake that traders make. Greedy greed. You see, greed. Something about greed is that you are never satisfied. You are never satisfied. So, but if you are a very good forex trader, you don't need to be greedy, because there's abundance of opportunity in this market. FOMO too. FOMO means fear of missing out. Some traders, because they see a particular setup, even if it is low quality, they try to jump into it. No, you don't have to do this. There's abundance of opportunity in this market. If your setup doesn't work out this time, it will work out another time, and there's always setup each day, each week, each month. So you have no issue, you have no problem. Always have it in mind that your setup is always will always play out. You will always see your setup. Just make sure that you are following your edge and following your trading plan and following the normal deal process. So don't be greedy and don't let FOMO affect you. Also, trading without a stop loss. In fact, this is one of the if you are trading without a stop loss, you are not. I don't see you as a trader. The first thing you do whenever you place a trade is to put your stop loss, because stop loss is what protects you from blowing your account, because there might just be a sudden price movement momentum that can cause slippage. So how are you going to protect yourself since you don't have a stop loss? So one of the biggest mistakes of some forex traders is that they don't use stop loss, which is a very, very bad thing. And number seven is over trading. I've explained this before also. Taking too many trades doesn't mean you are going to be successful in the forex market. But taking high quality trade is what will make sure that you're successful. And if you are going to be taking high quality trade, then you are not going to be taking just anyhow trade. So, and as I've said before, less is more. So, less is more. Don't over trade. Number eight is inconsistency. So, in this game, you have to be consistent. You have to put your skin in the game. You have to always show up to make sure that you are following your rules, following your training plan, and keep perfecting your craft. So don't be inconsistent. If you put your foot off the gas and then go off for a very long time, if you come back, it's like starting all over again. You'll be very, very rusty. So just be consistent and keep pushing. Number nine is revenge trading. This is uh this is common with traders that lose a trade and then try to um enter another trade to make for their loss. You see, one thing about this is that you are only going to be losing more because you are allowing the emotion of the previous trade. You are taking it into the next trade, and this is a huge, huge mistake. So one of the mistakes of forex traders is they revenge trade. Some forex traders they revenge trade, and this is a very, very bad thing. You are only putting your account at risk with this type of mindset. So you don't need to revenge trade. And the last one on the list is switching strategies. You see, like I've said before, it is not about technical analysis. It is about your psychology too, just not analysis alone. So if you don't get your analysis, there's no need to switch strategies. Just stick to it and understand it. Once you understand it, then work on your psychology. If you work on your psychology, then it will help you a lot. You don't have to switch strategy. If you switch to another strategy, if it doesn't work, are you going to switch to another one? Of course not. So why not stick to your strategy and then work on perfecting it and work on your psychology alongside too. So if you avoid these mistakes and then you stick to your plan, follow your training plan, work on your psychology, then it is going to help you a lot. So I wish you all the best in your trading journey, and I hope that it is the beginning of many good things to come in your life. I can't wait to see you all smash it. So this comes to the end of the Forex Beginners course, and thank you for coming this far. And I wish you all the best. Good luck.